And welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman. We speak to you about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon-to-be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think somebody might actually find this interesting or useful, believe it or not, feel free to hit the share button and send it to them as well. So, literally a half an hour ago. So that's how live, how unprepared this program is. I got an email and it was like sort of a questionnaire, sort of trying to find out about financial literacy. They asked, what would you do if you got 1,000 shekels? First of all, that was the basis. If you got 1,000 shekels, first of all, they wanted to check financial literacy, right? They said, so if you tie it up in a deposit, which pays 2% a year for exactly 1 year, how much money will you have, right? Those are standard questions, right? Will you have, 102? Will you have more than 102? 1,000, 1,002, 1,020 based on 100, 102. More than 102, less, whatever. Then, if you do it over 5 years and it can compound, will you have 110 or more or less? Basic questions about if you understand the concept of compounding of interest and very, very simple financial literacy questions. Then they said, okay, so you got your 1,000 shekels. What would you do? Would you spend it? That was number one. Question number two, would you invest it? Question number three, would you invest in crypto? And number four was, again, like, I don't know, something stupid. I don't remember what it was. It made a lasting impression. So I was like, huh? At least have an other. What about, like, maybe I'll pay off my mortgage with money that's found, the sum doesn't matter, right? It's they're looking for the concept. What would you do if you have found money, right? So I was curious, like, why don't they say pay back your mortgage? And why are they like crypto? So then I thought, well, maybe it's like some kind of a crypto company which solicited the survey or whatever, but it didn't look like it to me when I headed down to the small print. But to me, that's like really interesting, right? Obviously, investing money is great. I don't know about crypto. Okay, no comment. Running to the nearest duty free and blowing it on your whirlwind vacation, I don't know. Paying down debt would be also a good choice. Saving the money even in the bank would be a good choice. And I say, paying down your mortgage. And it struck me that oftentimes these questions are, let's say the alternative of paying down one's mortgage is never mentioned. Why is that? Why is it whenever you get money, invest it, but why not pay down your mortgage speedily, right? Well, maybe that's because, the big building, which has the name of the financial institution plastered all over it, won't make quite as much money if you actually prepay your mortgage. But it's so important that once you get to a certain financial level, and I know they're different opinions. Well, I locked in a low interest rate, so I want to arbitrage my investment returns. That's all great until it's not great. Now, I'm going to make 12% in the market, but I'm only paying 3.5% interest, so I should keep my debt around as long as possible. That's great until it's not great, right? Here we have what was called Provident Fund, Karen Hishtalmud. It's like a 6-year program, grows tax deferred. Your money goes tax deferred. And the big thing here when interest rates were zero was to borrow against it. Well, that worked out really well until interest rates rocketed up and markets have gone nowhere in Israel in the last couple of years. And all of a sudden people are scratching their heads like, whoa, nobody told me I was going to lose money on this deal. It always goes up. Everything always goes up. Well, it goes up until it doesn't. So when people start pitching you these kinds of things, think twice, okay? There's just something in the news of a real estate firm here that was promising, they denied they promised, but all the people who put in, the thousands of people who invested, especially the 70s and 80-year-olds, all swore that they were guaranteed between 6 and 8%, and voila, it looks like they're not gonna get a lot of their money, if any money, back. They're crashing and burning. If it sounds too good to be true, it is. If you don't understand it, don't invest in it. It's pretty simple, right? Which is why I'm going to go back to that questionnaire that I got, and I got to crypto, and I just skipped right over it, and I said, no comment, right? I don't know anything, but I don't know enough about crypto. I might be literate, right? I could maybe fool a lot of the people about crypto, but honestly, you know, hand on my heart, I don't know anything about crypto. And if you don't know the ins and outs of these things, stay away from them. Don't invest in them. But getting back to paying off the mortgage, that's a great thing to do. And once, I believe that once you are out of debt, you've got money to save, you're building for the future, that you should sort of save money. I call it on 2 tracks, right? Saving on 2 tracks. Track number 1, put money into savings, long-term savings, right? You should always be paying yourself first. 10 to 15% of your income go into savings. Once you're past that, you have extra money. What should you do with it? So the Dave Ramseys of the world, which are great, I don't have anything negative to say about that. Put it all to pay off your debt. I sort of take a hedge, right? I still believe that even above and beyond that 10 to 15%, if you get extra money, that's when I take the 2 tracks, right? Split it. Let's say you have a couple of $1,000s or tens of thousands of dollars extra. Put half of that extra money into savings, long-term savings, and put half of that money into the mortgage. So you're constantly whittling down your mortgage and increasing your savings, right? Because ultimately we don't know. Maybe it was a wise thing to arbitrage and you've got a locked in low interest rate. So it was a good idea because you did well in the market. On the other hand, like I said, maybe you have a couple bad years in the market, so you should be paying down your mortgage. We don't know. And because of that, I believe in doing it in both tracks. I think at the end of the day, that's probably the ways to maximize your net worth. Again, I'm not against sort of Ramsey that once you've paid yourself the 10 to 50%, everything above and beyond that should go to your mortgage. I don't think that's a horrible idea, but I think because we don't know, you can cover your bases. Anything above 10 and 15%, you split into 2. More into savings, and the other half goes into mortgage. The other rule that we should learn from all this is only invest in what you understand. Don't let anybody con you into high returns, 6 to 8% guaranteed. Guaranteed by who? It's not the government, it's some firm, right? Some real estate firm, because they're leveraging loans to somebody else, to contractors, I don't know. And they didn't even know. It just sounded like great marketing, and that's why it's blowing up right in front of our eyes right now. Not the first time, and it probably won't be the last, okay? So, number 1, pay off your mortgage. It's not a bad thing to do, but be smart about it, right? Save in 2 tracks. Pay yourself first, save above and beyond that. Any extra money, pay off your mortgage. Number 1. Number 2, only invest what you understand, okay? It should be basic by now. We've had so many scams over the years, but still people fall prey to these things. What can I tell you? You've been tuning into the Aaron Katzman Show. We speak about your life, your money, and your investments. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. Thanks so much for tuning in, and speak to you soon.